Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, January 13th, 2023. S&P 500 currently sitting at 3,990. I'm David Zarling. I'm here with Dan Mustache Gorkuber, Kevin Bob Vila Ferrari, and Pratty back to school Tulsian. Ian is on the road as we speak, so it's going to be the four of us gentlemen today providing great information to those who listen. It's always a pleasure and a privilege. If you guys like these episodes as you're listening, please give us a high ranking. That helps us get the word out. Fellas, it's been a while since we've been on this podcast together. And as we were about to step on the show, Pratty so appropriately pointed out that, what do you think, Pratty? That was like back in December, early December?
I think it was actually early October.
Okay, early October. And back then, we kind of went through a roundtable and each of us kind of talked about the things we would like to see that would get us bullish again, or put the thesis back in the camp of seeing demand outpace supply in the marketplace, or different market characteristics that we'd be looking for. And so I kind of wanted to go around again, revisit what those were, what we said back then, and where we are now. And I guess I'd go, we could start with Pratty, then go to Kevin, then go to Dan. And Pratty, if I remember correctly, small caps were a thing that you wanted to see. So I'll let you take it from here.
Yeah. So, I mean, we've touched on this so many times now that before stocks start going up, they've got to stop going down. And we know small caps stopped going down in June. And
Right.
Since then, it's really just been, mostly tech. And even within tech, on the larger side of tech, the market cap heavy names have been going lower, but many other tech names have actually bottomed. And if you look at something like IWM versus S&P 500, it's coming back up on that same neckline that it was in October. Back then we had a failed breakout, but this time we're coming back up on that level. And if we can break above something like 4080 on the S&P, I think that would be pretty good evidence to support the bull case. If price is now making a higher high and under the surface, you have that breadth expansion and small caps really start getting a move on a relative basis.
Yeah, no, for sure. And to kind of paint that picture, you used the phrase that small caps kind of stopped going down in June. What Pratty's not saying is that we knew it would stop going down in June. He's saying that that's where the furthest advancement that supply outpacing demand took us, around the 162, 163 level on something like IWM, which represents, it's an ETF for Russell 2000. We rebounded there into August, corrected back down in there into the September, October, and we've seen strength there since. And in addition to that, when we look at it on a ratio basis, IWM versus something like SPY, Pratty, you're saying we're at an important horizontal, an area of interest that if we break above it, probably is signaling some pretty strong participation and breadth and possibly a return to a bull market. Is that a fair summary?
Exactly. And I mean, it's also important to look at IWM on an absolute basis. It's gone nowhere since May.
Right.
So a lot of this could just be, a story about avoiding the largest tech names. Because if, the S&P is very heavily weighted towards Apple, Microsoft, Amazon, Google, stocks like those. And if those stocks keep going down, IWM is going to move higher relative to the S&P. So, it's important to also look at IWM from a, 30,000 foot perspective. And you can see it's been sideways. So we do want to see IWM move higher on an absolute basis as well, along with moving higher on a relative basis.
Yeah. To your point, when you say gone nowhere since May, if you just blinked your eyes and didn't look at a chart between that date and this date, we'd be at similar price levels, but we have an 18% range in between. So there's been plenty of chop. And this is what illiquid markets do. as they pull in buyers and sellers. And so the range gets bigger. We saw elevated VIX back then. And we're at really important volume weighted average price levels on something like IWM. If you look at it, we're up against that. This 186 to 188 level on something like IWM is hugely important from looking historically at the volume weighted average price going back to prior highs, meaning the all-time high back in November 21, the high in March 22, and even the high that was in August, all lower highs. But the average volume weighted average price from those peaks, we're at that pivotal point right now. And so that would be important to get back above that. Kevin, how about you? What were some things you were looking back at then, and where are we now?
Yeah, so I think the main thing for me was just, I guess at that point, was for bonds not to continue to get hit so hard and really just kind of show some life, which really is kind of crazy timing. That's almost exactly what they started to do basically once we had that conversation. I mean, if you look back the last 3 months, like AGG, TLT, I mean, they've kind of been making at least short term a series of higher lows, at least showing life. I mean, they're not getting hammered so hard.
Right.
As a start. I mean,
for sure.
If you told me I could only look at bonds and make a decision one way from there, it might be a hair early for me. But I think if you pair that kind of like a weight of evidence approach, and I think the outlook's looking a little more positive, at least I think.
Right. That's that inner market analysis of putting all the pieces together. It's not signal information, but it's environmental information. And it's a fact that buying has outpaced selling since October. And like you said, very prescient that took place, around our conversation time. And that goes back to the old adage, credit knowing more, the credit markets knowing more than the equity markets. It's nice to see something like aggregate bonds and treasuries not go down. And if you think about the different stages of a market, expansion and contraction, right? We had identified that for a while. You could argue since basically March of 2022, stocks, bonds, and commodities all were in downtrends, which is that stage 6 and stage 1 of expansion. So it's a full-on contraction or correction in all markets. And now we have a scenario where we might be seeing bonds bottom. Kevin's point is that the move so far since October, if you just looked at that, it would be counter trend in nature and doesn't necessarily mean we're out of the woods. But when you see something like junk bonds holding up really well versus the aggregate bond complex, it's worth noting that at least that's stabilizing, not out of the woods.
Right. Even like if you look at Chinese bonds, which I guess isn't something you'd expect to be as strong as it has been here lately.
Yeah.
I mean, they just kind of got shot out of a cannon. So it's kind of
you're using something like C-bond.
Yep.
False breakdown in November and has since ripped higher and kind of has matched the international story, which we'll get to in a second. But that's a good notice too. So you're just saying back in October, we wanted to see bonds stop going down. They have since then. It's a good first sign. It's not all clear to get, just October was not the all clear to get crazy exposed to this market. That's not what Kevin's saying. We're just saying since that period, we've seen bonds stabilize and move higher. Dan, how about you? What were some things you were looking at back in October, and where are we now with it?
Yeah, I think another one that we were kind of looking at was really just how the US dollar was performing and just even trending from a absolute perspective. For much of the last year to 2 years, pretty strong trends out of the dollar. And it was kind of, the theme was kind of like, hey, safety trade, US dollar versus everything else. And really just trying to see that kind of break down, right? And break down from certain levels that we were watching is something, good to see, right? Or at least from a bull perspective, right?
Yeah, in most I think it's fair to say in many, not all, but many market environments, a falling dollar is a tailwind for equities. Doesn't have to be,
Right.
but it's one of those things you look at and you're like, okay, the wind is behind us here. If we have something like the DXY, a trade weighted dollar falling, that tends to help equities overall.
Yeah. So, I mean, I think one of our levels that we were watching more on like a short-term basis was like that 109 to 108. And I'll probably give zones just because,
Right. Absolutely. We draw with crayons. We don't draw with pencils.
Exactly. Exactly.
I think we use paintbrushes sometimes.
Yeah. Paintbrush works too.
Picasso.
Yeah. Markets aren't black and white. They're not, supply and demand isn't dictated by a thin line. It's like you said, it's a zone or an area. So you said 108, 109 was a first area of interest.
That was more of like a shorter term to maybe even intermediate trend.
Actually, I remember that because that's when I changed my profile pic from the George Washington dollar with laser eyes to George Washington thug life. But I think where you're going next is I might be changing my profile pic this weekend to something completely different.
Ooh, I think I do know where you're going next.
Yeah.
But yeah, and then I mean, from intermediate short-term perspective, that level, and then obviously more recently here, the last week, just seeing that same Dixie trade weighted index, breaking like that 104 to 105 zone. It steadied around there for a good month, like basically all of December. But like I said, more recently, within the last week or so, it's kind of tried to make that move below, that 104, 105 zone. So
yeah, currently sitting at a 102 spot 16 for the DXY. So definitely on the verge of breaking the prior highs. I don't know that it's fair to say it's a false breakout because it was a pretty far move above that level. However, if that were to continue downward, it as we've said before, it tends to be a tailwind for stocks. And so here we have a situation where we're not seeing bonds fall. And that goes back to the 60-40 portfolio having one of the worst years on record for 2022. Bonds have stopped falling. We're starting to see some levels reclaimed elsewhere in the equity space, both on an absolute and relative basis. With the dollar below 103, those are three or four pretty good check boxes on what we'd like to see for equity strength. Was there another item there, Dan? I apologize for interrupting you. Was there another item besides DXY?
Oh, I think, I don't know if it was a few sessions ago or whatnot in terms of podcast episodes, but I think another thing we were kind of looking and waiting for was just to see if we had like a capitulation event.
Oh, right. That's right.
Would be, that would maybe be another thing that has, that's probably, I think that argument maybe could be, or that point maybe could be dissected. I think from a capitulation standpoint, you look across our entire universe of stocks, asset classes, foreign, domestic, et cetera. I mean, you probably did see some capitulation in certain areas and then not, like, you didn't see capitulation in others. So maybe a mixed bag from that perspective.
That's a fair point because, to define, maybe I can take a second to define capitulation for our listeners and what we mean by this. It's just that moment where everyone throws the baby out with the bathwater and there's massive selling, and you'd almost call it selling exhaustion, where you run out of things to sell. There was a capitulation during the COVID crash that was very obvious. And I don't mean obvious in like you could take action on it on that day. I just mean when you look back, right, hindsight bias, and you look at the data, you're like, wow, that was a really big capitulation moment. I think we could look back at some point and say, and unless we get another lower low where there is capitulation, I think we'd all be able to go back and look at the charts and say October 13th and 14th of 2022 could have been that moment. Looking at something like S&P, which gapped lower that day, and all it did was get bought the whole day. and we moved higher since. And if you look across a couple other indices, you see the same thing. Not as big of a capitulation as maybe we were looking or anticipating for. Definitely in that moment, it doesn't scream capitulation or that the market has to move higher from here. But I could see a year from now, where we're looking back and being like, look at that, look at that candle, look at that price action on October 13th, 2022, marked a significant bottom. But we'll see. Like, we could still see an event where we move lower. I don't want to make it sound like all the evidence is higher, but the evidence we were looking for back in October has continued to line up towards a bullish thesis for this market. You guys push back on me. Is that a fair summary of everything that we've just said here?
Yeah, I think it's fair.
Okay. Because I mean, I'm perfectly willing. I get told I'm crazy all the time. It doesn't hurt my feelings. This is America. We don't need to get offended about everything. So where should we pivot to from here? What are some things that have piqued our interest that is worth highlighting for those listening in this current market environment? We mentioned reclaiming important levels. I know for me, when we talked back then, that S&P 500 4080 level is still pretty important. We're below there. However, we're trying to work on this falling 200-day moving average. We're right against the rate of trend line, a falling rate of trend line on the S&P 500 that connects the prior highs. Some other areas may be breaking above that, and there's definitely areas of strength that are notable and areas of weakness that are notable. And one area of weakness that I think about is something like staples versus the S&P 500, which could be giving us a false breakout signal here, which would mean more risk on to come. What other things like that you guys are seeing that are worth paying attention to?
I think, well, when you mention, I guess, more so risk on, kind of like how we've been shadowing, like especially last week, kind of more activity on the international front. Which has been pretty noticeable. I mean, I know for the most part, I think Europe was probably the most evident at that point, at least last week. That's kind of continued. I know we talked about China a little bit. It's kind of cooled off lately. It's kind of hanging out there. I don't think it's necessarily really kind of decided which way it wants to go, but you're kind of even starting to see some of those Latin American countries too start to come into play. Like this week, at least for me, the kind of one that's been fun to watch is Mexico. Well, I guess even Argentina too. They're kind of a tie there.
I was going to say we can stop crying for Argentina because
no kidding.
That I encourage any technician or lover of charts to go look at a chart of ARGT and zoom out and see what you find. Yeah, do it weekly and see what you find. There's something going on in Argentina. I know that in that particular product, Mercado Libre, MELI, is the largest weighting. And that still has room to run, even though that ARGT is having, because what is that base, Kevin? ARGT goes back all the way to like 2018.
Yeah. Yep.
It's a big old smiley face. And so does that scream risk off if we're buying Argentinian stocks?
Yeah, I mean, really, you're kind of starting to see a little bit of life from emerging markets too, which not exactly a flight to safety, and wouldn't think for most people. So I don't know, and even Turkey we've been talking about for how long. I mean, you're just starting to see a lot more participation even on just the international side of it.
Right. And I think the interesting thing from a technical, technician's study of supply and demand perspective is because, we like talk shop and how do things bottom, et cetera. And here you have a potential diamond formation on something like IWM that we could look back on as being accumulation someday. The Qs could be like a double bottom, but here out of international, it's another V bottom. So not all bottoms are the same, but your point is valid. Things like Mexico, Argentina, Europe, the fact that they're perking up for the last couple months is definitely notable.
Yeah, that kind of makes sense when you think about the dollar too, right? A little bit. I mean, that doesn't really surprise you that both are kind of showing a little life.
Amen. I mean, that's spot on. If you're going to have dollar weakness, and your most dollar sensitive areas you'd go Latin America first.
Mm-hmm.
When we look at relationships, Latin America by far has the most inverse relationship with the dollar, meaning when the dollar is strong, it's Latin American stocks are weak. When the dollar is weak, Latin American stocks are strong. There's times where Europe is inverse, but there's times where they ride together. But it's definitely notable to see all that taking place. And you're right. And maybe this dollar move to the downside is just beginning. If we're going to close below 102, 103 on something like the Dixie, I think that's information. We got to sit back and take stock of that and maybe buy stocks. What else, guys? What, Dan, Pratty, what are you guys noticing right now that's worth highlighting for those taking this in?
So I guess like going back to the risk on, risk off, I know you mentioned Staples versus S&P with the failed breakout. If you look at equal weight discretionary versus equal weight staples, that's actually breaking out today.
Really? Let's take a look at that. So you're using RCD versus RHS for that?
Yep. And what's interesting is that this picture that you see here on the equal weight side is very different from the market cap weighted sector. So XLY versus XLP, well, that's putting in maybe a failed breakdown. It's testing the underside of, these former lows, but the equal weight sector is actually breaking out. So again, just goes back to the idea that it's really the large cap names like Tesla and Amazon in XLY that's dragging that lower.
Yeah, I'm glad you brought that up. And your point about even the cap, large cap one of XLY versus XLP, you do have a pretty nice weekly divergence on RSI, the Relative Strength Index, on that chart. So that's going to be fascinating to watch. But you're right, on the equal weight level, we're seeing discretionary outpace staples, which is risk on behavior, which also explains why in some instances we really have seen strength from equal weight. And that highlights your point, Pratty. Large cap growth, your large cap tech lagging your equal weight and your value, really going back to March of 2020 in some instances. Like you look at something like RSP versus S&P, it's really since back then that we're seeing strength out of equal weight versus tech or versus large cap. Dan, how about you? Anything else that you're looking at?
Yeah, kind of touching on the earlier conversation from the small cap space with IWM. I think just kind of like coming back to the, what has been the context and narrative of the market, and then is there anything changing? I think, one of those things would be like that IWM DIA, the Dow relationship. So the Dow, Papa Dow, from
Big Papa Dow.
Yeah, from November, December 2021 to really pretty much now, it's kind of been the relative leader within this domestic index space, right? And we're starting to see, evidence where that is starting to shift, where, it's still a relative leader from a new highs perspective and maybe some internal like stocks perspective, but that IWM DIA relationship is reclaiming some critical long-term lows that we previously had taken out.
Yeah.
So I don't know, there's something kind of keep an eye on. And
you have a similar RSI divergence going back to the beginning of January 22 in that relationship of small caps versus the Dow Jones Industrial. And it's happening you zoom out, it's happening at that response in that relationship is happening at arguably an important horizontal level that goes back to 2003.
Right. It's a very long-term level. So yeah, feathering the cap to the small caps probably there.
Right. And there could be more room to run yet in that relationship to the downside, but you also wouldn't be surprised if that was it. Meaning that this is the point where small caps outperform the Dow Jones Industrial for a while. And that would be, in my opinion, hugely bullish, because that would speak to breadth expansion, right? Mm-hmm. Anytime you see the small caps outpacing the large cap areas, that speaks to participation. And maybe that's a great segue towards what are we seeing from a breadth perspective, not bad breadth, meaning, but like BREADTH, breadth participation. Are we seeing any improvement there?
I would say there's definitely been improvement, especially in the NASDAQ composite. So we'll have these charts up, but if you look at the percent of stocks above their 200-day moving average in the NASDAQ, that's been diverging from what price has been doing since the summer. Again, just like, how we mentioned small caps bottomed in June, turns out a lot of the components inside of NASDAQ also started reclaiming their 200-day moving average since then. So in June, you only had like 10% of stocks above their 200-day moving average. But in October, when the NASDAQ made a new low, you had 17% of stocks above their 200-day moving average. And more recently, again in December, even though the NASDAQ, it's still, right there at the lows. I think it actually closed at a new low in December. But the percent of stocks above their 200-day moving average again went up to about 34%. So under the surface, you're seeing more stocks reclaim their 200-day moving average, despite the fact that the index hasn't really moved up yet.
Wow, that is fantastic. And if I could repeat it, because I really think that's important, and then you confirm whether that's, if I caught it correctly. So you're saying using the NASDAQ composite, so not the NASDAQ 100. So you're using something like the IXIC, the IXIC.
Right.
And you've got a price level of about, let's call it 10,290 that was an October low, but the percentage of stocks at that point within that index above its 200-day was 17%.
Yes.
Versus June, which was actually a higher, the around 10,800 on that index was around 2%. So you have this divergence. You have a lower low in October, but more stocks above their 200-day moving average.
Yeah, so we went from 10% of stocks to 17, and now
10 to 17. Okay,
right, and then in the most recent low on December 28th, 34%.
Yeah, that's what we call divergent breadth, right? You've got price low in the index, but more stocks above their respective 200-day moving average. That's great.
And I guess like another point is that right now we're still 5% away from the 200-day moving average, but 51% of their stocks are above the 200-day moving average. So again, if the index is 5% away and more than half of the stocks are above the 200-day, you have to wonder how weak are the few stocks that are below the 200.
Right. Well, and that again points to the weakness out of the big ones, the big stocks. Your Apples and your Microsofts and things like that. Because I saw something that actually it didn't surprise me, but I don't think it's getting enough talking about. But I believe the weighting not being patient, but within the S&P 500, the value of the top 5 stocks in the S&P 500 has fallen significantly. And this is actually something shared by Brandon Van Zee, who does tremendous work, by the way, and you can follow him on Twitter. But the weighting of those top 5 stocks in the S&P 500 not too long ago was around anywhere from 23 to 22%. We're now at 16%. So we're seeing this massive shift of these top 5 stocks that are weak while these other things are starting to do well. And that's a really important dynamic, especially for portfolio construction, if we're going to get an ongoing bull market and trend moving upwards, that somehow carving out those big names will be important as part of that process.
Right. It would definitely make it a lot easier for the index at least to move up if energy, industrials, and financials are moving higher. And even if tech isn't participating, if it's now become a smaller part of the S&P, it would certainly make it easier for the index to move up.
For sure. Totally agree. So what else? What other breadth measurements or things that we're looking at are worth noting at this time?
Yeah, so I guess, a recent data point that we came across here, just looking internally at some scripts we wrote, we found that the percent of stocks above their August highs So at any point from August 1st to August 30th, most stocks, looking at the indices, most stocks basically did the opposite of a V bottom. So, we know now it was a bear market rally, and stocks peaked somewhere in the middle of August. So looking at their best closing price from August, about 30% of US stocks today are actually above that level, even though the indices aren't anywhere close to there.
Which again is another, exclamation point behind the anything but the big five or anything but large cap is probably the way to be positioned. Again, not a recommendation. That's not what this podcast is about. Anybody listening to this, you're an adult, you make decisions on your own. But Pratty's point is another box checked for, as if this market continues to unfold to the upside, it's likely that we're going to continue to see weakness out of the big names. And so portfolio construction will matter as we come out of that. And some of it we can point to, going back to Dan and Kevin's point about some of the things we're seeing internationally or with small caps versus the Dow Jones. You're starting to see the evidence pile up for a 2003 to 2008 type scenario where you're seeing value, international, small, Pratty, you said financials actually outperforming to the upside, and we could just be getting started. And that's going to drive some people nuts because what's the narrative of today? Recession, inflation. But we know that markets are future discounting mechanisms. And so it's not 1-to-1 in time. It's typically looking out 6 to 12 months in the future. And how many times has the market actually bottomed as the recession is being announced? It happens all the time because it's not like the market is surprised when we have the backwards looking data, right? Because price is the most recent information we can get. There's no like future data that we get to look at. There's estimates, but how many times are estimates wrong? But when we look at like GDP or earnings or any of those things, they're revised months afterwards, whereas we get to operate in price, which is such a blessing because it's the now and it's about anticipating the future. And so it wouldn't surprise us to see this market bottoming at this point and moving higher and confusing a lot of people as the recession data comes in, and that's the news headline. Time will tell. Things could get, the market can roll back over. I have no idea. I'm not here with a crystal ball. But at this point, there's certain things that are starting to show up that are pointing to more evidence in the court of supply and demand that points towards demand outpacing supply. And so I guess at this point, I'd like to maybe talk a little bit about the opposite of October, meaning at that time because things were so negative to the downside, we were trying to keep our minds open on what we'd like to see to the upside. I don't want to give the impression that we're out of the woods, first and foremost. We're definitely still within a range in a lot of these indexes, but we're starting to see the evidence stack up of bull market behavior upon us. What are some things that you're looking to see either hold to confirm that, or that you're looking at that you're like, hey man, this, like, we're not even close. We're not even, like the risk is still high to the downside here. Do you guys have any thoughts on that? And I realize I'm putting you on the spot with this. And so don't everybody jump at once. Anybody want to take that one first?
I just think from a price perspective, right? Like it would be, we talk about like confirming domestically, at least, and kind of following the rest of the world. Be nice to see the S&P 500, making intermediate term highs here or a break above, the recent high. So I would maybe consider like that December, October 13th, December 13th, December 13th high. That'd be a pretty critical level to kind of, I think that's like the 4150 to 4200 zone on like S&P futures.
Yeah, so you're using ES. So that's actually something that happened, I believe, in the morning session.
Yeah.
And that high is approximately, it's 4180 on the spot. That's interesting. Only because we've talked about 4080 and 4180 on here multiple times. But I agree with you, because what you're saying is, and actually it's not a matter of agreeing or disagreeing. It's about having a thesis, and the thesis of upside would be confirmed by reclaiming that 4180 level, because you would be creating on a days to weeks time frame a higher low from this past December.
Mm-hmm. Mm-hmm.
And so that would be further evidence confirming upside behavior. And that would be good from a bullish thesis perspective. Anything else? It could be Dan, Kevin, Pratty.
No, just because you get kind of to play off that a little bit. So I know we mentioned it before, that downward rate of trend in the S&P from kind of the end of 21, beginning 22. Because at least on the cash side, that December 13th high, exactly tested that downward rate of trend. And that's the last time we've done that. And as far as rates of trend go, I think they've kind of followed this one pretty cleanly. So I almost think, to me, at least it'd be, at least at this point, that's almost more interesting to me, I think, than 4180, just with how clean it's been. So
right,
it's kind of going to be interested to see this next time they're trying to come up and test it, what happens there.
Yeah, because if we say the words rate of trend, sometimes we don't realize what we're saying.
Mm-hmm.
It's literally the rate of descent that we've seen, the higher end of rate of descent that we've seen since the beginning of 2022. It would be nice to see that rate of change broken.
Mm-hmm.
And that would be a great step one. And so that coinciding with that horizontal level anywhere between 4080 and 4180 that Dan's talking about, reclaiming a 200-day moving average, you're really, and this is happening with the breadth improvement that we're seeing, you're really starting to lose excuses for why this is a bull market.
Yeah, you're starting to check a few boxes at that point.
Right. I should say that differently. You're losing excuses for why this wouldn't be a bull market. Pratty, any additional thoughts on that as well?
Yeah, I guess just looking at individual stocks and their characteristics in a bull market, I would want to see, I guess, the volatility around the breakouts reduce. So, we've seen a lot of breakouts, and then a few days later, the stocks come back in, deep retests. You'd want to see breakouts have follow through. So you break out and then 2-3 days of follow through at least. And that's something you'd probably see in a bull market rather than a bear market.
No, that's a great point. You're talking about characteristics, right? So how often in the correction from the beginning, now there's two corrections, and I want to be careful here, because you have a correction for the majority of stocks that has taken place from February, March of 2021 on the indice level from January 2022. And during that whole period of time, you could argue for almost 2 years, we'll call it 23 months. The characteristic that Pratty is talking about is you would see a stock make a new intermediate term or daily to weeks time frame high and then fail. And he's talking about having those now stick would be confirmation of a different characteristic that's more indicative of a bull market than it is of a bear.
Right, because that would just mean that there's so much demand for the stock relative to supply that you don't even need to retest, and the stocks just keep going after the breakout.
Yeah, it's a big deal. There's nothing wrong with that. We'd love to see that after basically a 2-year bear market. That would be a welcome change for investors, right? Because I know Vandatrack came out with some data in December, and the average retail account was down about 35%. And so here you have a scenario where we're starting to see, and we haven't even talked about seasonality yet. We haven't even talked about the third year of a presidential cycle, or the year that's in between the midterm election and the presidential election, and how typically bullish that is. We haven't even touched base on, we had a positive Santa Claus rally and a positive first 5 days. And if you have a positive January, what some significance that has, but it's not predictive. But there are definitely pieces that are starting to line up here that are very hard to ignore towards the upside. I even think about a chart that, Dan, that you just shared internally that's risk on, risk off in when you look at the spectrum of risk, and that would be like micro caps. When's the last time we talked about micro caps on here? It's been a long time.
I didn't even know they existed anymore.
You're like, what are those? But the fact that you could potentially be in a scenario where small caps, which we just mentioned previously, are showing positive relative characteristics, would underperform micro caps potentially here going forward. That's also risk on, that you would be buying the smallest of the stocks. It's an interesting, and I don't know if that was the intent of sharing that chart, Dan, but that's what stuck out to me.
Yeah, it's definitely a decent inflection point right now, both horizontally and rate of trend. So yeah, IWM versus IWC, another one to kind of keep an eye on from that risk on, risk off
For sure.
perspective.
And so we've given a lot of time to equities, whether it's domestic or international. We've given some time to bonds or credit, some time to currencies. We haven't really talked about commodities or crypto, and we don't have to because we've done a good job with the information we provided. Is there anything in those areas that you guys want to touch base on before we finish up this podcast?
Are you going laser eyes? Is that what you were referring to earlier?
No, I'm actually thinking I might go back to my regular profile picture. I was laser eyes for the trade weighted dollar going back to November of 21. And then I went to thug life, meaning like, that people survive. But now the DXY is below 103. When you study enough supply and demand, it's hard to think of the dollar going straight down. It's back to, like the bottom part of the range near 88. Like typically you don't see price act that way, but man, if it did that, how bullish that would be for equities. And, it's below a 200-day moving average. It's below important horizontal levels. It has a declining 50-day moving average. Trade weighted dollars in trouble here. Yeah, that's what I meant by it, I guess.
I thought you were going to change it to the peso, but I don't think I was even close on that one.
Maybe the Brazilian real.
Good.
Or any other currency versus the dollar. Maybe that's where we're at. I think one interesting dynamic from a breadth perspective is we do appear to have recorded a breakaway momentum, which is just a rate of change that's happened over a prior period that I know Walter Deemer and Mark Ungerwitter have highlighted in the past. And they don't come around very often when you see them. And they typically start a new bull leg, or they mark the ongoing or confirmation of a bull leg. And we just recorded one.
The information about that.
Oh, did you hear that? That was that's my
Google?
Yeah, that was my Google trying to tell me what breakaway momentum was. Trying to get on this podcast. I told Google they could not be on this podcast. No, so breakaway momentum. We've got this rate of trend change, or not rate of trend change. We have this breadth expansion from it. And so this breakaway momentum, it's something that Walter Deemer came and identified in the 1970s. And really what it is it's just this powerful thrust forward by observing a 10-day New York Stock Exchange advanced decline ratio of basically 2-to-1, 2 advancers to 1 decliner. And so it's not 100%, but it's really in the high 90% of cases when this happens, it signals the beginning of a new bull market, or at least a new, intermediate move in a bull market. And we just recorded one this week. And so that, to me, that's a big deal. The last time we saw something like this was in like June of 2020. Coming out of a COVID low, we saw this breadth expansion, this increased participation of stocks. And we didn't look back for, double-digit percent. And so we've just gone through a bear market in the majority of stocks from February, March of 2021, a bear market in from an indice level since the beginning of 2022. Again, it's another piece of evidence that's piling up that we could see stocks moving higher from here, which would not fit the recession narrative for many. So I've talked a lot, including somehow getting Google involved in this. Anything else you guys want to wrap up with before we close this one down?
I think really the only thing we didn't necessarily touch on, at least on the commodity side, like some of the metals have been looking pretty good lately, like especially the base metals. I know Dan's been on a copper train here this week, and I'm starting to get a little bit nervous about having rolls of wire laying around my house.
Yeah, where are you going to put
copper
those?
Value. I'm going to have to buy a safe or something.
Trains made of copper. Sounds kind of heavy.
Mm-hmm.
That's a great point, because if we're buying base metals, I'm not saying we're buying base metals. I'm just saying if demand is outpacing supply for base metals, are we buying base metals if the economy's bad? Are we buying base metals if it's risk off?
I mean, I wouldn't be. I don't know what other people are doing, but yeah, it wouldn't be my first thought.
Right.
But then that's the interesting thing too. Like you look at gold today, I mean, gold's having a good day too. It's kind of interesting.
Yeah, gold has that false breakdown from back in September. There's that time frame again, September, October. And we don't get to be surprised by that either, because previously, if you look back at the past year, if you priced gold in anything but the dollar, it was okay in moving higher. We're now in a scenario where gold priced in the dollar has some, dare I say it, value.
Ooh.
A store of value. That's going to fire people up.
Here we go.
Just
We'll bring it
on.
Yeah,
we're going to be full now.
Yeah, exactly. Anything else, guys? Open forum. Throw anything you want out there. You could talk about anything but the NFC championship game from the early 2000s between the Vikings and the Giants. You could talk about anything else.
Oh, no, you went there.
It's a rematch. We don't want the 41 donut game. All you New Yorkers know, we want the Vikings to win. They're all turning this off right now.
Yeah, I almost turned you off.
Oh, appreciate that, Ferrari. Anything else?
Nothing here, I guess.
I guess there is one thing. The VIX is breaking down below a pretty significant level.
Yeah, that's an important dynamic that, the VIX isn't at a level since basically we haven't seen since the beginning of the year. And it's actually if you guys pull up a chart of the VIX, if you look at rate of trend, so the low in the VIX from January 2018 versus the low that took place in late 2019, early 2020, the lows in 21 to now, we're at a really important level from a rate of trend. And I know people are going to get all weird about, can you do technical analysis on the VIX? And our simple answer here is yes. It's going to be interesting. If that continues to cool off, you don't typically see an environment where the VIX is cooling off, which is basically just a measurement of volatility or a measurement of premium paid for options. Seeing that cool off typically is another one for risk on behavior or a melting up of equity prices. Is that kind of where you're going with that, Pratty, as far as information?
Yeah, I guess like another thing I just noticed is that, one of the first things I learned about the VIX is that the VIX generally moves inversely to the S&P. So, if you have the VIX moving up, the S&P is moving lower. And throughout 2022, the VIX never really, in February, it got up to 37. But since then, it never really took that level out. And again, obviously, this goes back to the conversation we had earlier about, the capitulation not being super evident in the indices, besides that October 13th day. But, I guess if you ask me what would it take for me to get bearish again, it would probably be, this breakdown in the VIX turning into a false breakdown and then VIX spiking higher.
That's a great
capitulation.
That's a great segue. So you're saying either below this rate of trend and then move higher, or reclaim something like 19.35. If we reclaim that on the VIX, that could be a warning sign. Is that kind of what you're looking at?
Yeah.
Okay. No, that's good. I like that. Kevin, Dan, anything else?
No, I would add that with the VIX, if anybody does, we can take up the challenge. If anybody does challenge the TA on the VIX, VIX futures are traded, so we do have volume and price. And
if you've got volume and price, how are we not using technical analysis?
I mean, that's 101 right there. So
right, exactly.
I mean,
now Dan's DMs are going to be full.
Lock them now.
I'm staying out of it.
Oh, that's funny.
So Kevin, I got off Twitter. So I got off.
So Kevin, are you good?
Yeah. I mean, unless people want to hear about how that Google thing that's probably in the background said thank you for somebody telling me bless you when I sneezed once. We can go over that story. That's always a good one.
Ooh.
And things are always listening. Telling you.
It is. Oh, we all know. We know.
Mm-hmm.
Yep. That's how you get the advertisements and the well, we won't go there.
They're polite though. So that's
good. Yeah. As long as they're polite. And that's really what we all ask for. Is just let's be polite. Guys, great job. We missed Ian, but I know Ian's going to listen to this. You guys, this was fantastic. Really good information. Thank you for doing this with me. And I know next week it's kind of a opposite relationship, and I look forward to listening to you guys while I'm out of the office. But thought you guys brought really good information. I appreciate all of you. Each of you bring something to the adaptive team that makes it special. And so I really appreciate you guys. And we all also thank everyone that's listening to this. Like I said at the start, if you like this, if you appreciate the information, one of the ways that motivates us and keeps us going is if you can give us a higher, a high ranking on your platform that you like to use, as well as share it on whatever platform that you're on. That really helps us. Otherwise, we're going to wrap it up, and we're going to wish you guys all guys, we've got a 3-day weekend.
Yeah.
Trouble. No, everybody enjoy the 3-day, the 3-day weekend. That's awesome. And we'll see you all again in a week.